Welcome. As a part of a sound financial plan, you definitely want to consider an emergency fund. This helps tackle those little things in life that can happen unexpectedly, such as a major car problem or a water line break going to your house. Now, typically, an emergency fund, people think of putting cash aside in a savings or checking account, somewhere very liquid and accessible, so that they have it at a moment's notice to take care of these emergencies without going into debt. There is, however, another option you have, and there are some other benefits associated with this option that you should consider. So what I'm going to talk to you about is how to leverage stocks that you already own to create an emergency fund. So this involves working with a brokerage like Robinhood or M1 Finance. Some of the fintech companies out there are ahead of the game in terms of offering this kind of service to the average retail investor. And what this allows you to do is borrow against your stocks in the portfolio and receive cash instantly that you can transfer to your checking or savings account and do with as you wish. Now, this may sound too good to be true, but it does come with some terms that you want to consider. First, you typically charge interest based on the federal funds rate. So in 2020, for example, the interest you could expect to pay on a margin loan in these types of accounts was about 2%. But under the rising interest rate conditions that we face today, this is about 5%. In addition, with your stocks being the collateral for your margin loan, if your stocks go down in price substantially, this could cause your stocks to be sold in order for the margin loan to be paid off in full. Typically, if you own quality stocks, the margin requirements are relatively low, such that you would have to have a 75% drop in your stocks before you would be liquidated. So if you own large quality ETFs or companies, it's pretty unlikely that this would occur even in the worst of economic depressions. So how would this work? Let's go through a hypothetical example where you have a $10,000 stock portfolio invested in Apple. And let's say you needed to cover an emergency expense of $3,000 to repair your car. You would go to your Robinhood or M1 portfolio and request a margin loan of $3,000 against your stocks. This would be a 30% loan to value ratio. You'd have $3,000 available, you'd withdraw it to your account, and then you would owe your broker a $3,000 loan. At a 5% interest rate, this would be a monthly interest payment of $12.50 that you could choose to pay off at any time and no longer have to pay interest, but as long as you hold this loan, you'll hold $12.50 in interest a month. And as long as Apple's share price, in this case, doesn't decline more than 75%, you can keep that loan open indefinitely, which over the long haul, it's pretty safe bet that that's going to not be a problem. So there you go. You have an instant emergency fund. You didn't have to sell anything and you didn't have to hold a bunch of cash on the side. And the big benefit here is, especially under these high inflation times, if you hold cash in a checking account and get no return, you're losing 50% of your purchasing power in 9 years. So this is a way to put your cash to work, continue to allow your investments to appreciate, and if you have an emergency where you need to call some cash together in order to pay a major expense, you can use margin to take care of that. If this was helpful, please like and subscribe and comment. This will help this content get shared with more viewers, and I look forward to creating more helpful content to you in the future. Thanks.